What's up, YouTube? Eric here, Mr. Fired Up Wealth. Excited to bring you 5 stock picks today. These are going to be dividend growth stocks, small to mid cap. And I only own 1 of the 5 stocks on this list. The other 4 are on my watch list. And I'd be willing to bet you there's a couple of stocks in this list, guys, that you've never even heard of before. Now, I always stress the importance of having a diversified portfolio, having a blend of growth stocks, spec stocks, dividend stocks, ETFs. These dividend stocks will give you some of that balance. They're in different sectors. 4 of the 5 are outside of technology. So if you're tech heavy, these could give you some balance. These are a blend of dividend growth stocks as well as DGI. They're small to mid cap. If you're new to the channel, if you haven't subscribed and this is helpful, make sure you subscribe, click the bell to get notifications, and make sure you guys drop a like and a comment. Let's get started. Let's start off with a curveball. You know, I like curveballs. This first one, I bet you a lot of you have never even heard of. It's called Otter Tail Corporation. Ticker is OTTR. It's a small cap company. This is a $2.36 billion market cap out of Fergus Falls, Minnesota. Pays you almost a 3% dividend yield at 2.91%, and it's only an 8.09 P ratio. Now, this is a utility company, so it's pretty boring, but there is a twist here. 70% of their business is focused on utilities and primarily in renewable energy sources like wind turbines, wind farms in North Dakota, South Dakota, and Minnesota. The other 30% is actually manufacturing and pipe production. Plastic pipe production as 30% of their revenue, and that's where some of their growth is going to come. If you look at the stock, it's at $57. If you look at pre-pandemic, back here in February of 2020, it was around the same price, $55, $56. So their strategy is to continue to grow their largest business, the regulated electric utility, which will lower our overall risk, create more predictable earning stream, improve our credit quality, and preserve our ability to fund the dividend. And they have increased the dividend each quarter, each year for some time. They've done a good job with that. 70% electricity, 30% from the manufacturing and plastic pipe, and that continues to provide organic growth. Organic internal growth comes from new products and services, market expansion, increased efficiencies, and so on. We expect much of our growth in these businesses in the next few years will come from utilizing existing plant capacity from capital investments made in previous years. I think this is a good stock at a good price, attractive yield, attractive P/E ratio. Otter Tail, take a look, OTTR. Now, this next one is FLO, Flowers Foods. This is a really interesting company. Now, this is considered a small cap from Fidelity at $6 billion, $6.2 billion in the market cap. Some people would consider that a mid-cap stock. It pays you a 2.99% dividend yield, again, almost 3%. This one is a bit more expensive. It's a 28.57 P ratio. They continue to grow. They continue to make acquisitions. They continue to grow their dividend. So these guys do packaged bakery products in the United States, breads, buns, rolls, snack cakes, tortillas, and so on. They own brands like Nature's Own, which you've probably heard of, and you didn't know that Flo owned them. Dave's Killer Bread, which is something we buy at Costco all the time. Wonder, so Wonder Bread, Canyon Bakehouse, Mrs. Freshly's, and Tasty Cake brand names. The company distributes its products through a direct store delivery distribution and a warehouse delivery system. 46 bakeries, 44 owned and 2 leased. And these guys have been around since 1919. Again, it's Flowers Foods. Now, if you look at the chart, this thing has run pretty hard. It's one that's being bought, so you have to be careful. It has run recently pretty hard from 24 to 29. In the grand scheme of things, if you're a growth investor, that probably doesn't look like much. But this thing, you can see if I look at a 5-year chart, you know, it's kind of stayed in the same range. It's going to give you that nice dividend yield and I think slow and steady growth. So it's probably not going to be a big outperformer. Give you some balance in the portfolio, about a 3% dividend yield. This one's Flowers Foods, Inc. Now, this next stock I have brought to the channel before, NetApp. And in fact, we bought this in Discord around 45 and we sold it at $90. Now, it has pulled back. You can see it got down to 61, so it's made a nice bounce off that. It's trading around $73.88, and it topped out around $96, $97. You can see in the pandemic, it got down to 35 or so. Now, this one's a 17 P ratio. They're getting more and more into cloud services. It pays you a 2.75% dividend yield. So all 3 of these first 3 stock picks pay you close to a 3% dividend yield. This one is a mid cap. It's around $16 billion at $15.76 billion. Now, if you're not familiar with NetApp, they do a lot of hybrid cloud. So it provides cloud-led and data-centric services to manage and share data on-prem and private and public cloud worldwide. It operates 2 segments, hybrid cloud and public cloud. So when you think of public cloud, usually you think of Amazon Web Services, Microsoft Azure, Google Cloud Platform. There's other players like Oracle, NetApp, and so on. These guys are doing some good stuff behind the scenes. It's one of those legacy type companies a lot of people just don't think about. And if you're going to compare, say, an IBM to a NetApp, I would buy a NetApp all day long over IBM. A little bit less yield, but I think there's more upside on the stock appreciation. This one's NetApp, ticker is NTAP. Now, this next stock I identified as a potential 10x stock pick. This is MGP Ingredients, and it has run hard. In fact, I was looking at it, it was about 100% lower than it is now originally. It's a 23P ratio. This one does have a small cap of about $2.6 billion. It's located in Kansas. It has a smaller dividend, but I consider this a DGIF. So it's a little bit more dividend on the stock price, and that dividend will continue to grow. This is one that could give you a lot of appreciation and compounding over time if you hold it for 5 and 10 years. Estimated dividend right now is only 0.3933%. So it's 0.4%. It's very small. The first three stocks are more in that DGI. This is more the DGIF category. Now, one thing to note, guys, I want you to be careful because the short interest is 19.66%. That seems extremely high. I'd be very cautious. I don't know if I'd necessarily go out and buy this one right now. I'd put it on your watch list. I like it much better below $100. When I started looking at this stock originally, it was way back here around $70, $75, something like that. And it's run pretty hard. I had it on one of my 10X videos. Just a quick overview of the company. So they work in different segments. They've got distilling solutions. That's 56% of their business. Branded spirits. That's 29%. So actually branded bottles of bourbon and so on. And then ingredient solutions, not only for the liquor business, but also for baking goods and things like that. When you think of non-GMO, gluten-free, things like that, specialty baking items. Leading U.S. producer of specialty wheat proteins and starches, rapidly growing category with significant long-term upside. It's only 15% of their business right now. I think a lot of their growth could come through there. And if you look at high quality kind of distilled spirits and those high-end brands, those have done really well. Now in a recession, maybe people will buy those less, but they do have a blend of high-end and mid to low-end. Now looking at their family of spirits, it's very diversified, I think, and the price points range from $15 for Irish cream down here on their left, all the way up to Yellowstone Limited. This is a straight bourbon whiskey at $100 for a bottle, and kind of everything in between. They've got tequilas, they've got bourbons, they've got the Ezra Brooks, they've got some vodka, they've got Everclear, which I didn't realize until I started doing research on this company that they're the ones that are actually behind Everclear. A lot of people probably know about Everclear from some terrible college experiences and so on. But MGP, guys, MGP, check it out. It's something you have to be careful with at $120, but long term, I think this one has a lot of potential. It should be on your radar, MGPI. Next, I'm going to cover my favorite stock on this list, the fifth stock. Before I do that, I need to announce this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/Fired Up Wealth. We also have a private community for Fired Up Wealth, including a Discord that you can join. Check out patreon.com/Fired Up Wealth. Last but not least is Wingstop. Now, another one you have to be really careful with because it is expensive. And this one actually has a 111P ratio, which you could argue is too high. But there are some reasons for it. They've been paying special dividends, but they're also trying to grow internationally, and they're trying to grow into places like China. Now, if you look at a company like Domino's Pizza, it might sound boring, but it gave you 1,000%, 1,500% return over a decade. This could be one of those stocks. This could be a compounder. It's a small cap right now. It's under $5 billion at 4.71. It pays a dividend around 0.5%, 0.48%. That P ratio, though, is 111. Be careful. And the short interest is 10.68%. So this is one that has to pull back. I want you to put it on your radar, on your watch list, but it needs to pull back. If I look at a 2-year chart, this thing got all the way down to 67, 70 bucks, and it's literally ran over 100% from the bottom. So you have to be really careful. I'd much rather have this closer to $100, $120 or less. Check out this next slide, though, just the possibilities for this company long term. Okay, before we do that, look at the growth. 5-year stack domestic growth in the United States. They're killing everybody. Chipotle, Domino's, McDonald's, Taco Bell, Starbucks, all of them. 49.6% right here. The compound annual growth rate, 5-year unit, 12%, blowing the doors off of all the major brands. They've continued to have same-store sales, domestic growth, record net new restaurants. They keep growing more and more of these restaurants. They're not crazy expensive to build. Plus, on top of that, chicken wing prices have come down, which has helped their profitability. Their earnings have been very strong here the last couple quarters. These guys are trying to grow, and they're involved in that digital transformation. So companies like Olo are behind these guys. I think over 65 or 70% of their orders are digital. Their potential, here's the slide, 7,000 global restaurants. Now, of course, this is going to be sugar-coated because it's an investor deck, but domestic market, they want to have 4,000 and international 3,000 restaurants. They're involved with premium content, NBA, NFL, March Madness, Premier League. They're really focused on building out out and supporting their existing markets. You see the United Kingdom, France, Indonesia, Singapore. The next tier is developed and targeting markets. You can see like Thailand, Saudi Arabia, South Korea, Canada, and then they want to grow into major markets like China, Italy. They're prepared to enter China when the timing is right, and they think that they could build, and that's part of the reason why the stock trades at such a high premium, guys. I hope this was helpful. Please subscribe to the channel if you haven't. Click that bell to get notifications. If this was helpful, drop me a like, drop me a comment. Appreciate your time and attention. Have a great rest of your day. Take care.